When you apply for a loan today, you're not talking to a banker anymore. You're being judged by an algorithm. In 2026, over 80% of loan decisions in the United States are influenced or fully automated by artificial intelligence. This isn't just faster, it's fundamentally different from how loans worked for the past century. Traditional lending was simple. A bank officer looked at three things: your credit score, your income, and your collateral. If you had a steady job, paid bills on time, and owned a house, you got the loan. If not, you didn't. This system had clear rules. Everyone knew what mattered. AI lending doesn't work that way. Instead of looking at three factors, AI models analyze between 1,000 to 10,000 data points about you. This includes obvious things like your bank balance, but also unexpected patterns: how you fill out the application form, what device you're using, even the time of day you apply. One European bank's AI system discovered that people who apply for loans between 2 a.m. and 5 a.m. default 23% more often than daytime applicants. Nobody programmed this rule. The AI found it on its own. Here's how the system actually works. When you click Submit on a loan application, your data enters what's called a machine learning model. This model was trained on millions of past loan applications. It learned patterns from people who repaid loans and people who didn't. The AI doesn't understand trustworthiness the way humans do. It only sees mathematical correlations. For example, the AI might notice that people who use all capital letters in their application default 8% more often, or that borrowers who round their income to the nearest thousand are safer bets. These patterns mean nothing to you or me, but to the algorithm, they're statistical signals. The most common AI system used is called a neural network. Imagine it like layers of filters. Your application data passes through the first layer, which looks for basic patterns. Then a second layer combines those patterns into more complex ones. By the fifth or sixth layer, the AI has created a risk profile of you that no human could articulate. It's not thinking, this person seems responsible. It's calculating, based on 10,000 similar data patterns, this applicant has an 87.3% probability of full repayment. This creates a massive problem: the black box effect. Even the engineers who built the AI often cannot explain why it approved one person and rejected another. In 2023, a software engineer in California was denied a mortgage by an AI system. When he demanded an explanation, the bank said the model flagged irregular financial behavior patterns. He had excellent credit. The irregularity? He had recently paid off his student loans early, something the AI interpreted as unusual and therefore risky. Banks love AI lending for three reasons. First, speed. A human loan officer takes days to review an application. AI does it in 0.3 seconds. Second, cost. JP Morgan's AI lending system processes applications at 1/10 the cost of human underwriters. Third, scale. AI can evaluate 10 million applications simultaneously without getting tired or making emotional decisions. But AI also looks at data you never consented to share. Some lenders use alternative data, information beyond traditional credit reports. This includes your social media activity, online shopping patterns, even your smartphone usage. One fintech company's AI checks if you keep your phone battery charged above 20%. Their data shows people who let their battery die frequently are 12% more likely to miss payments. The logic? Both behaviors show poor planning. In Kenya, a loan app called Tala uses AI to scan your phone contacts, text messages, and call logs. The AI checks if you communicate regularly with employed people. If your social network appears financially stable, you're more likely to get approved. This sounds invasive, but for millions of people without traditional credit histories, it's the only way to access loans. The accuracy question matters enormously. AI lenders claim their models predict defaults with 92 to 95% accuracy, but this statistic hides a problem. The AI is accurate at predicting the past. It learned from historical data, which contains historical biases. If banks in the 1990s discriminated against certain neighborhoods, and they did, the AI learns that people from those zip codes are risky without understanding why. In 2019, Apple launched a credit card with AI-based approval. Thousands of couples discovered the husband was offered 10 to 20 times higher credit limits than the wife, despite identical identical incomes and shared assets. Apple claimed the AI was fair because it didn't explicitly use gender, but the AI had learned patterns from decades of data, where women earned less and had less credit access. It perpetuated inequality without anyone programming it to discriminate. This is called algorithmic bias, and it's nearly impossible to fix. You can't just tell the AI, "Don't be racist" or "Don't be sexist." The bias is buried in mathematical correlations the AI discovered on its own. For example, if you remove race from the model, the AI might still use zip code, grocery shopping patterns, or music streaming preferences, all of which correlate with race. A study at UC Berkeley found that AI lending algorithms charge Black and Hispanic borrowers 0.08% higher interest rates on average, costing them collectively $765 million per year, even when their credit profiles are identical to white borrowers. The defense argument from AI companies is that humans are worse. Traditional loan officers absolutely had biases, conscious and unconscious. They denied loans based on appearance, accent, or gut feeling. At least AI is consistent. It treats everyone by the same mathematical standard, even if that standard is flawed. Here's what makes this dangerous: scale and speed. A biased human loan officer could discriminate against maybe 50 people per week. A biased AI system processes 50,000 applications per hour. If the algorithm is even slightly unfair, it amplifies that unfairness millions of times before anyone notices. The regulation problem is serious. In the United States, the Equal Credit Opportunity Act says lenders must provide specific reasons for loan denial. But how do you provide specific reasons when the AI used 10,000 variables in ways its own creators don't fully understand? Banks often give generic explanations: insufficient credit history or debt-to-income ratio. These may not be the real reasons the AI rejected you. Some countries are fighting back. The European Union's AI Act, implemented in 2024, requires explainable AI for high-stakes decisions like lending. Companies must be able to show exactly why the AI made each decision. This sounds good, but it creates a new problem. The AI that's most explainable is often less accurate. The most powerful AI models, the ones that find the most subtle patterns, are also the least transparent. China's approach is different. Their social credit system integrates AI lending with government surveillance. Your loan eligibility connects to whether you jaywalk, pay taxes on time, or criticize the government online. The AI becomes a tool for social control, not just financial evaluation. Meanwhile, new problems keep emerging. Deepfakes and AI-generated documents can now fool even sophisticated AI lenders. In 2025, a fraud ring in Miami used AI to generate fake pay stubs and bank statements that passed verification checks, stealing $18 million in fraudulent loans. The defense? They built an AI to trick the lending AI. It's an arms race. For you, the borrower, this means loan approval is increasingly mysterious. You might be denied for reasons that make no logical sense, or approved when you expected rejection. The AI sees patterns in your life that you don't see yourself. Your digital footprint, every app download, every late-night Amazon purchase, every Venmo transaction feeds into the calculation. The future looks even stranger. Some experimental AI systems now use biometric data. They analyze your voice stress during phone calls or facial micro-expressions during video applications. The theory? People who are lying or financially desperate show physiological signals they can't consciously control. This crosses from financial evaluation into psychological profile. We're building a world where your access to money to buy a home, start a business, or survive an emergency is controlled by mathematical systems that no one fully understands, that perpetuate historical inequalities, and that judge you based on patterns you never knew existed. The AI doesn't hate you, it doesn't favor you, it simply calculates. And increasingly, that calculation determines your life. Okay, that is it for today. I hope you have liked this highly informational video. Subscribe this channel if you want such videos on different topics in future too. Thanks for watching. Catch you in the next one.